Week one is over, and almost nobody is talking about what it actually cost you. Not what it cost governments, not what it cost oil companies, not what it costs financial markets, what it cost you, the person sitting at a kitchen table paying bills, the person filling up a car with fuel, the person buying groceries for a family, the person trying to save money for the future. Because the truth is this: when a geopolitical conflict begins, the first price is not paid by governments. It is paid quietly by ordinary people. Through higher fuel prices, higher food prices, higher borrowing costs, and a rising cost of living. 7 days ago, the global economy looked very different. Inflation was falling. Central banks were preparing to cut interest rates. Investors believed the worst economic period after the pandemic was finally ending, but 1 week changed the entire direction of the global economy. Oil prices surged, markets became volatile, and central banks suddenly became cautious again. Most people think wars only affect politics and military strategy, but wars have always been economic events first. They change supply chains, they change commodity prices, they change interest rates, and sometimes they change entire decades of financial policy. So today we are not going to talk about politics. We are going to talk about something much more important: what this moment means for your money, your savings, your investments, your future financial security. Because history shows that during moments like this, there are two kinds of investors. The first group reacts emotionally. They panic, they sell, they make decisions based on fear. The second group pauses, they analyze, they look at history, and they make decisions based on patterns rather than noise. And over decades, those two reactions create dramatically different financial outcomes. The difference between them is not intelligence, it is perspective. So before we talk about what might happen next, we need to understand what already happened. Just 1 week ago, Brent crude oil was trading around $70 per barrel. That level was considered comfortable for the global economy. Energy costs were manageable. Transportation costs were stable. Inflation pressures were finally cooling. And central banks around the world were beginning to prepare for interest rate cuts. After years of rising rates, investors were finally expecting relief. Mortgage rates might fall, business borrowing might become cheaper, consumer spending might improve. The global economy appeared to be stabilizing. Then suddenly everything changed. Oil prices surged dramatically. Within a single week, Brent crude jumped to nearly $90 per barrel. That is a massive move in the energy market. Oil rarely moves that fast in such a short period of time. To understand how unusual this is, you have to look at history. The last time oil experienced a weekly surge this large was during the global pandemic. Before that, you have to go back decades. Even during major global crises, oil rarely moves this aggressively in 1 week. It arrives gradually. $1 extra for fuel, $2 extra for groceries, a slightly higher electricity bill, a slightly higher heating bill. Individually, these increases feel small, but across millions of households, they represent billions of dollars quietly leaving consumer budgets. And that is why energy markets matter so much, because energy prices influence almost everything else. Right now, analysts are watching one number very closely: global oil supply. The world currently consumes around 103 million barrels per day. If supply falls even slightly, prices can move dramatically. Now imagine what happens if several million barrels disappear from the market. Some analysts believe disruptions could reduce supply by several million barrels per day. That might sound small compared to global consumption, but in commodity markets, even small shortages create huge price swings. The last time the world experienced a supply shock close to that scale was the 1973 oil embargo. That crisis triggered years of inflation and economic instability across many countries. It reshaped monetary policy. It changed how governments think about energy security. And it influenced economic policy for decades. Today, economists are watching carefully to see whether this moment becomes a temporary disruption or a longer economic shock, because the duration of supply disruption matters far more than the initial price spike. A short disruption might raise prices briefly, but markets eventually stabilize. A prolonged disruption creates sustained inflation, and sustained inflation forces central banks to act. Over the last several years, central banks have been fighting inflation aggressively. Interest rates were raised to levels not seen in more than 2 decades. These higher rates slowed the economy intentionally. The goal was to reduce inflation without causing a severe recession. And until recently, it appeared to be working. Inflation was falling, economic growth remained stable, and central banks were preparing to slowly reduce interest rates. But rising oil prices complicate that plan. Energy inflation spreads quickly, and central banks cannot ignore it. If energy costs remain high, inflation could rise again later this year. That would force central banks to keep interest rates elevated longer than expected. For households, this has real consequences. Mortgage rates remain high. Credit card interest remains high. Car loan rates remain high. Borrowing money becomes more expensive. And when borrowing becomes expensive, economic activity slows. That is why markets pay such close attention to oil prices during geopolitical conflicts. Because oil does not only influence energy markets, it influences inflation, interest rates, consumer spending, and economic growth. But there is another important perspective here. History shows something surprising about financial markets during geopolitical crises. Researchers studying market history analyzed dozens of major global events over the last 80 years. Wars, terrorist attacks, economic crashes, global pandemics. Across all these events, a consistent pattern appeared. Markets usually decline slightly in the immediate aftermath of major shocks, but over the following months they often recover and eventually continue rising. Why does this happen? Because stock markets ultimately follow corporate earnings, and most geopolitical crises do not permanently destroy global business activity. Companies adapt, supply chains adjust, technology evolves, and economic growth resumes. The investors who historically suffered the most during crises were not those who owned the wrong assets. They were the ones who made emotional decisions during moments of maximum uncertainty. They sold during panic, they exited markets near the bottom, and they missed the recovery that followed. The most successful long-term investors often did the opposite. They remained patient. They focused on long-term fundamentals rather than short-term headlines, and they avoided making permanent decisions based on temporary fear. This does not mean crises are harmless. They are not. Economic disruptions can be painful. Energy shocks can create real inflation pressure. But history suggests something important. Markets eventually adapt. The question is not whether uncertainty will appear. Uncertainty is permanent. The real question is how investors respond to it. Smart investors focus on 3 principles during periods of uncertainty. First, they protect purchasing power. Inflation slowly erodes savings that earn little interest. Money sitting idle in low-yielding accounts loses real value over time. Using higher-yield savings options or short-term government securities can help offset inflation pressure. Second, they avoid emotional reactions. Selling quality investments during market volatility often locks in losses unnecessarily. Markets historically recover over time, but only investors who remain invested participate in that recovery. Third, they maintain financial flexibility. An emergency fund is one of the most powerful financial tools during uncertain periods. Having several months of living expenses available provides security. It prevents investors from being forced to sell investments during temporary market declines. Financial resilience is not about predicting the future perfectly. It is about preparing for multiple possibilities. Because the truth is, no one knows exactly how geopolitical events will unfold. But history does provide guidance. Yet over long periods, economies continue growing. Innovation continues, businesses adapt, and markets eventually move forward. The challenge for investors has never been information. It has been psychology. The hardest part of investing is controlling emotional reactions during uncertain moments. Fear is powerful. Headlines amplify it. Social media magnifies it. But long-term wealth is rarely built through emotional decision-making. It is built through discipline, patience, and perspective. Right now, the world feels uncertain. Oil prices are volatile. Central banks are cautious. Markets are reacting to new information every day. But uncertainty has always been part of financial history. The investors who succeed are not those who avoid uncertainty. They are the ones who navigate it calmly. They focus on long-term fundamentals. They protect their financial stability. And they refuse to let short-term noise dictate long-term decisions. Because the most expensive financial mistakes in history were rarely made by people who were uninformed. They were made by people who reacted emotionally to temporary chaos. When the world becomes loud, that is exactly when disciplined thinking matters most. And the investors who remember that principle are often the ones who build the most wealth over time.